Welcome back to smarthelping.com. I got a nice model here. It's for a mobile app with in-app purchases. It's designed specifically for an app. I don't, you might be able to apply it to standard SaaS, but it's designed really for a mobile app setup in a business startup. So here's why I'm doing this. I had two other models that were kind of like this. I had a straight up freemium model, which just had ad revenue and then the option for you to have those people pay a fee to remove ads, and that was it. It didn't have in-app purchases. I had another model that was a mobile app, but it was also for SaaS and it had like five pricing tiers. It had a free pool, but it didn't have any ad revenue and it didn't have in-app purchases. So now I've made this, which has the in-app purchases, the revenue if people want to pay to remove ads, and also ad revenue from those that don't. So this is like for any standard app you're gonna build onto a phone, uh, or any product that you want to make that has like in-app purchases and ongoing user engagement. So we're gonna dive into each tab. I'll get into every single assumption, how it works, and you probably learned something about finance in this too. So here we go. First up, setting the time is important. So this date, you want to put the very first day of the year you're going to launch. So 1/1 and then whatever year. That's going to define your 5 years of time that all the assumptions fit into. Then you have an exit month. It could be, you don't have to, you could put NA or you could do any month within the 5 year period. And as soon as you hit that month, all activity and revenues and cash flows stop after that. And the debt is automatically repaid if you have any. At that exit date, there's a multiple here, which is based on EBITDA, and it's going to give you the trailing 12-month EBITDA times this multiple to give you the exit value if you were to sell the business. That's important because when you go to sell, your investors want to try to value if they're investing in this, or if you're just putting your own money into it. You want to know, if you were to sell the business, how much is it worth? Um, Otherwise, you'd have to run the model into perpetuity and just discount the cash flows until they're eventually zero. And that's kind of tedious to build out that many months, and it's more, you've got more data if you do it this way, more insight. Uh, okay, so next up you got cash sources. So this is how, you're gonna have the funds. It's probably gonna cost some money to start up the app. You're gonna have to pay developers. You're gonna have to buy who knows what web designs. You're gonna have to spend money. So to get that money to spend, you're either gonna have it get it from debt, like from a traditional loan, and then anything else that debt doesn't cover is gonna have to come from equity. This equity could be from investors, which you have here, and you give them some share in the resulting implied valuations there, or the equity and the remaining equity, if they don't pay any or don't pay all of it, is going to have to come from the owners or operators of the business. And that is set, this number is set to default at the minimum monthly cash value. So in theory, assuming all your assumptions are 100% correct about what it's going to cost and what money you're going to make over time, uh, this is the bare minimum equity you need. You can plan for a reserve if you go to a startup and put in, say, just a startup reserve here of, let's say, 250,000. Then technically when you go to zero, you'd have $250,000 left based on that reserve, because that reserve is being taken into account when figuring out how much equity you need up front. So you've got your start and exit assumptions, you've got your funding sources. Now let's get on to the fun stuff, revenue and growth. And I've tried to really explain each section here to give you more insight on what's going on, but in general, all these assumptions I'm making here are arbitrary for all tabs. I'm just putting in numbers that they might not even be reasonable. It just depends. So when you actually get this model, you're going to want to go through every single assumption and see what makes sense for you and then put in what makes sense for you. My job is just to make sure when you put numbers in here, you get an accurate P&L and cash flow result. So let's get into it here. The first thing you have is ad spend. If you're going to have an app, it's likely that you're going to pay money to advertise that app to get users to come download it. So you've got the dynamic start month and the monthly spend per year. So here you can see we're spending $10,000 a month. If the CPA is $1.50, that means the users you're acquiring per month are just 10,000 divided by $1.50. Now I've got this improvement in CPA here, meaning you're getting better at acquiring users at the same price. Assuming all else is equal, you get to sign up more users with the same amount of spend on ads. This could be 0%, it could be higher, whatever. It's just there to give you more tweaking abilities to assert, your strategy and back up. You're gonna have to back up these assumptions with data, but to do that, you also need to have the assumptions work, which is what this template's doing for you. You can see that flows into the monthly here, 6,666. Month or year two, it's a little bit higher because your CPA has gone down, so you're acquiring more users. Now, if your ad spend went up, this would probably go up as well if your CPA is staying the same or going down. Next up, you've got organic traffic. So this is the other way people can sign up. So the first way is you've got ad spend to get people to download. The second is word of mouth organic. This is obviously super desirable, but it's hard to get. You've got to really make a name for yourself somehow to get this, but if you do, you're going to have people searching for the name of the app or telling their friends or just searching for things and they end up coming across it on a Google search or their phone search and they see it. So you've got a hard-coded number there of what you think your monthly traffic is from organic search and what that percentage improvement might be per year on your monthly traffic. And then, based on that traffic, you can define what percentage of it you think will actually download the app. So you can see here, we're saying 250,000 views a month, 10% of them download. And you can change the percent to whatever. Right now it's 10. It could be 1%, 0.5%, 0.1. It could be 75%. Just depends on what app you're doing and the whole entire environment that you're entering. You can see that changes over time. Now, if we go back, we now have so we know how many people are actually available to download. Now we want to say of those, how many decide to pay to not have ads because your mobile app, now your mobile app does not have to have ads. This could be 100% and you have nobody doing ads because you don't have ads on your app. That's completely fine. You just put 100% here. This goes to 0. And you now for year 1 have no ad revenue. You see total ad-free revenue, 0. And then you just zero out the assumptions for the ads as well. Here. Now you're assuming no ad revenue, and then this is from people paying, but you also don't want, you're saying there's no ads, so you would also put this to 0. And you see now this is 0 for the first year. So you can easily zero that out, no problem, if it doesn't apply to you. You undo that, put it back how it was. So you have, we're just saying 90% end up just watching the ad, so they're subject to the CPM. So this is what advertisers will pay you to advertise in your app. If it's 2,500 impressions per user per month, and advertisers are willing to pay 25 cents per thousand, that means for one user, you're making 2.5 sets of 1,000, so 2.5, and you're getting paid 25 cents per, so 63 cents. Now this number could be higher, it could be $15, $10. It just depends on the content of the app and what exactly it is. It really depends. So you have to research all this. Same with the impressions you think one user will have per month. This could be like 10,000, 100,000, a million, well, probably not a million, but just depends on your app and how many times you're showing ads on your app. So there's that. This is the fee for those that 10% that don't want ads. They pay this amount per month, and that's your service fees revenue, which is pulling in right here. And then this is your fee CPM revenue from impressions based on your total user count and how many impressions they have. Now, the next part is you've got in-app purchases. So we're saying of the total users that exist, including both the ones that are paying and not paying for ads, this percentage of them will buy something in the app. Now, that could be something aesthetically, uh, like something you might want to buy to improve your stat. I don't know. There's all kinds of in-app purchases you can have for. You can like pay to upgrade, get through levels, or have better, more levels, have better stats, make things easier. There's all kinds of ways that apps charge money uh, as one-time purchases, and some of those could be recurring. Some of those might not, but in general, you just you have 5 slots here to determine what your in-app purchases cost for users, and then you can define of your users that are buying things, what percent will buy each of these, and they're not mutually exclusive. So this could be literally 100%, meaning every month all these users that are going to conduct or are going to engage in in-app purchases will buy each of these whatever the in-app purchase is. They'll buy it once a month. Or you could do like an average of, you could say if you do want to make this mutually exclusive, you could just make sure this doesn't go over 100%. And it would basically just say X percent pay this a month, X percent pay this month, this month, this month on in-app purchases. And you just have like a low, mid, and a high or whatever. You can zero any slots out that don't make sense. You could also just have one row. You could have one row that says, okay, on average, active users spend this amount of money per month on in-app purchases, and just do one number without trying to break it out. My job was just to make it um, flexible to fit possibly different kinds of scenarios, but also be broad enough to really fit almost anything to do with in-app purchases and the revenue you can make from it. You can also dynamically change the start month of these as well. Uh, Here, one of the most important assumptions is what the churn is going to be. This is probably one of the most difficult things to understand, but essentially, you can define how long you think the average user will stay on your app. That's like their retention. So here we're going to say 2 years. Now, this could be different. It could be half a year, zero point 0.5 years, a year and a half, whatever the case is. It depends on your industry. But let's just say it's 2 years for the sake of argument. And we've got an improvement that you can apply to that. So you see it's going up, meaning users that join in year 2, you're saying they might last a little bit, they might stay longer for whatever reason. The app might be better. There's all kinds of reasons, but you could put 0% if you don't think that will change over time. Based on that 2 years, you get the next calculation, which is how much of the users that join will be there after 12 months. So if they're there for 2 years on average, then after year 1, you've lost half of them. And you can see that's 50-50. And then after year 2, you lose all of them. So if you start with 100, you lose 50 in year 1, you lose 50 in year 2. Year 2 is what your retention rate is. So that's how it goes to 0. You don't know when they're going to leave, but the average assumption here is that between year 1 or month 1 and 24, you're going to have 0. So this churn will take every user cohort that signs up and reduce that amount over the next 60 months based on what this number is. And they'll do all dynamically in these matrices, which we'll go over in a second. So you've got that. Then you've got the resulting monthly amount, which is just an even amount. So saying you have 100 people sign up in month 1, month 2, you've lost 4%. Month 3, you lose another 4% of the 100, and so on evenly until you've lost them all. And then that's dynamic as well. So the people that join in month 5 and month 6, they lost 4%. Month 7. So this is going to really, your churn is going to be very dependent on when you sign up users. If you sign up a whole bunch of users in year 1 and not as many in year 2 or 3, your churn is going to be high in year 2 and 3 because it's based on when these people start to come out. And if you're not adding as much as you did here, your churn is going to be higher in these months relative to how many people are coming on. So this is, let's just go to the matrix now. So we got two matrices, one for the free user cohort, and these are people that are not paying for ads, and then these are people that are paying for ads. And we had to do two separate ones because we have two pools that we need to track. Now, the first thing tells you, okay, month 1 cohort, how many signed up? Month 2 cohort, how many signed up? And see, we didn't start till May, so that's the first time we have a sign up. And you're saying 28,000 users signed up in month 5. Now, length of life. So this is, okay, this is all dynamic again, and it's saying month 5, you've got one. They signed up, so this is month 1 for them, month 2, month 3. The reason why we have to do this is because we need to know what year it is in the life of the user, so we know how long they've been there, and we can do percentages on how many should be remaining. There's also logic here that is looking at these different retention rates. So everybody who joined in year 1 will have this as their basis. Everyone who joined in year 2 will have this. So over time, based on this improvement, it's possible that users that join in year, let's say 4, will be there longer than users. They might be there for 19 months, or let's say 26 months, where these users were only there for 24 months. And that's all, again, dynamic with these matrices. You can see, I'll demonstrate that right here. Month 5 cohort, you can see how they last 28, then they lose a little bit more, and this is just that group, how much is left over time. You can see 24 months is how long. Now if we go down to, let's do one of these months, we're in month 34's cohort. Look at that. It's now lasting for 25 months before they're all gone. So whatever the numbers are, is based on how many signed up, but it takes now 25 months for a given group to completely deplete. I think this logic is really cool. I started doing it a couple of years ago, and it gives you more advanced and more maybe more accurate way to figure out what your user churn is over time, and an easy way to explain it. Like, okay, I got 28,500 that joined here. After 1 month, I lost some. After another month, I've lost some more, and so on until eventually, because your users that sign up aren't just going to 100% of them keep using the app actively forever. It's not realistic, so you have to have this, somehow you have to make this logic work, and this is the way I think it makes the most sense. Then you've got the year joined. This is where we're dynamically figuring out what churn rate to use based on what year the cohort joined in, or yeah, what retention rate to use. Then the churn can be derived from that. And you can see this churn, or this is applied, so when we actually see the total users 1,460,000, that should match our monthly ending value for the free users, which it does, 1,460,000. And then matrix 2 is the same exact thing, but it's only signing up based on what users join that are paying for ads. 162,162. So all that ties out. That's good. And the reason why we had to separate those out is because one of them is going to have monthly revenue based on service fees, and the other one is going to have ad revenue. So you can see here when we start to calculate ad revenue, we do ad impressions of the users that are doing free, and then some multiple of that, and you get ad revenue based on the CPM. And these users, you just multiply them by whatever the monthly fee is for not having ads, and that's how much revenue you get from them. Then, so for in-app purchases, same. We already went over the assumptions, but here's actually happening. This is staggered because I put staggered months just to make sure the assumptions are all working. In-app purchases, the revenue from that, and then you got total revenue down here. So now we've gotten through the control and revenue and growth tabs. I've fully explained how everything is working here. Let's move on to fixed expenses. So this is pretty straightforward. I have this standard in most models. It's just fixed expenses. So you've got G&A. I did 32 slots for that. R&D, you've got 32 slots for that, and 32 slots for sales and marketing. Also, sales and marketing, the ad spend that's up here, 10,000 a month, is going to fill in. You can see I put it as the last slot for the sales and marketing. It's right here. So for the fixed expenses, you can pick the month it starts. And this is why I have dynamic revenue start dates, because you might be doing R&D, research and development and everything, um, in months before revenue starts. So that burn, that net burn, is going to have to be calculated, which it is. And that's why the equity requirement is based on the net negative or minimum cash position that exists, which takes into account burn. So that's why all these timing assumptions are important and useful, and this is the sleekest way I could find to do it. All right, so you just got the amount per each slot per month, what the cost is, and then you could change that each year. Let's say you wanted to give these guys raises or whatever, or you wanted to keep, say, a slot here, but you want multiple people to be in it, so you just double, triple, quadruple, whatever the actual monthly amount is. All kinds of ways. This is just to get you fixed expenses, logic, having a dynamic start month. Also, you put in if a salary item is here, and that's going to define if it's subject to payroll and benefits, which is another G&A expense. You see in the G&A, that's the last row here as well, and this is dynamically counting, depending on if this has a 1 in it or not. And then if it does, it just does this payroll tax and benefits percentage times the total amount. So I did that for G&A, R&D, and sales and marketing. We then have some variable costs, so these are considered also G&A. So it's a percentage of revenue going to credit card fees. Okay, where was I? Revenue from credit card fees. So you see on our monthly G&A, that's going to go here based on when revenue starts, and it's just saying some percentage, let's say 10% of all revenue is subject to the fee, and then the fee is 1.7%. These again are assumptions that are up to you, but they're needed in there. Then you've got variable cost of goods sold. So this is like if you have users paying, like to host all the users on your app, you're gonna have to pay a hosting provider or some servers or buy servers. So this is just estimating that cost based on a per user basis. So here we're just saying it's 10 cents per user. It could change over time. Then you've got cost of goods sold on fixed. So this is any other cost of goods sold you think you might have that are you can get into a fixed monthly amount for each of the years, and you can do the start month of those dynamically as well. And then that's how we're getting down to our gross profit based on all of that. Let's get into we talked about payroll tax, corporate income tax. Now taxes are tricky. I just put in the monthly P&L, I just did a hard coded depreciation line, and then I just you've got EBITDA, then EBIT, and then you've got some debt service. So then your taxable income is just taking your EBITDA minus, or I'm sorry, it's taking your EBIT, which is taking EBITDA minus depreciation, and then this is doing EBIT minus interest to get how much is taxable, and then that's being applied if there was a positive cash flow month, based on the annual taxable income. And that was positive, so there's some taxes there based on that rate. Now, if you don't want to deal with taxes, you can just zero it out. Just zero out this 25%, and you could just say, well, this is all pre-tax money, and you wouldn't need depreciation then, and you could just say that the distributions are going to be taxed, if it's a pass-through or whatever. A lot of people do that, so you don't got to worry about trying to put taxes into the model, but I just have it here just in case you want to. And then you've got net earnings, and then when you actually go down to calculate your cash flow on this model, um, it's going to go based on EBITDA. It's going to reduce all the debt service, not just interest. It's going to reduce the taxes, and then it's not worried about EBIT or any of that. And then you're going to look at debt proceeds, repayment, sale of business, capex, startup costs to get the rest of your actual cash flow that happens in each period. So those fixed expenses, taxes, startup and cap. So this is if you want to account for other expenses that aren't, you just can't fit it in the other operating expense sections. And you want it to be in there though, you can put that here, and that will go in year 0. Also, if you have capex that you think are planned for the future and it's just a one-time amount, you can also put that there. This is probably what would result in your depreciation most likely, but those things are so specific, it's hard unless the model specifically built around depreciation happening, which this is not. So that's why I just hard coded it in for depreciation and tax purposes. But at least you can account for the correct cash flow. Debt, you can define the terms of the debt here, and the actual amount is going to be based on what you put on the control tab on debt proceeds. And then that's going to dynamically flow and to assume that on the exit month, any debt that exists will be paid back as well. So based on that, you've got the monthly tab that kind of populates based on all those assumptions I just went over. You've got some key metrics here: revenue per user per month, gross profit per user, customer acquisition cost, months to payback, customer acquisition cost, lifetime value per total revenue, lifetime value per gross profit per user, lifetime value to CAC ratio. This is always good to be around 7 or 8 or higher, obviously, is better. Your monthly churn rate, which is a result of retention, it's right there. Break even month, and then this is just active month to figure out taxes. If you exit on a non-fiscal period, it knows what EBITDA to take. Taxes, it knows how many periods to count when dividing it up into the months. And then we got our annual P&L. It's the same as the monthly. It's just rolling everything into an annual basis. I don't know if I went over matrix 3. This is just what I did to calculate the payroll tax and benefits based on if you've got a 1 or not. This is all dynamic as well. And these matrices are super, like they seem kind of laborious to do, but they really make the logic make sense. And I've used them for all kinds of situations where you've got to track what's going on with an individual monthly cohort over time relative to everybody else and get some nice monthly number based on the aggregate of all of them existing. Finally, we'll go to the results. So distribution tab, this is just showing what cash was returned, what cash was used. So positive cash flow months, negative cash flow months. Then we know how much remaining equity, and this is remaining equity after startup costs. So it's saying your startup costs are this. You got debt proceeds. After accounting for all that, you still needed to come up, or you still have 300,000 left. You've total put in 648. So that's your actual equity requirement for the internal rate of return calculation on the project. That's what's used. And you can see year 1. So most of that cash was used to pay for these outlays. So that's why you're actually getting the full positive cash flow back. Now, if you went through these calculations, which I encourage you to do, you'll see how it works and why it makes complete sense. And this is actually one of the best ways to figure out if you're defaulting into equity requirements. This is the best way to figure out how much cash is actually distributable each year based on inflows, outflows, and spend and capex and everything else. So this is a really nice set of formulas to do. I first developed it when I was doing the ATM business because that required a lot of capex every other month. So it messed up the calculation if I did it a certain way. So the most dynamic way that accounts for literally anything can happen, it'll give you the right numbers. I had to do this kind of advanced logic here. Then once we know how much is available and how much was spent, the investor will get, based on their percentage defined on the control tab, that share of the cash flow. Owners get that share, and then each of them have their own internal rate of return. And I just did a nice chart here to show cash flows, requirement, and distributions to each the investor and owner side of it. Now, if you don't have investors, then you can just zero that out, and it'll just show your owner will be the same as the project. You've also got an executive summary here to go over your main line item, so total revenues, like year-end active users, total revenues by revenue type. There's those three I mentioned. Cost of goods sold, your G&A, sales, marketing, R&D, then total expenses, your EBITDA, and that should match the monthly P&L, 67,826, which matches 67,826. Yep. And the annual. I did all these checks already, but I'm just triple checking. Yep, 67,826. So all those should all match. Then you've got all these. You've got debt service coverage if applicable, if you do have debt. You've got annual EBITDA per active user, which is just kind of an average. You don't need this, but you might find it insightful. Then other cash flow items, you've got taxes, capex, debt service, startup costs, proceeds from the exit, loan proceeds, loan payback, equity, and remaining cash balance. I also put in a little summary here for the project for the investor and the owner. It just shows internal rate of return, equity required, total cash return, equity multiple, and project ROI, or ROI, and it does for the investor and owner as well. We've also got break even month and year. Finally, we got visuals, so the total revenue, gross profit, EBITDA, cash position, primary expense items during operation, user acquisition. Now, I did some of these visuals. I put a lot of time into some of them, trying to do things I'd never done. So I've shown here your user acquisition of both the types, which is the lines, against the acquisition cost per customer over time, which is the columns. I thought that was kind of interesting to see. I also did over here what the customer acquisition cost is relative to the lifetime value based on total revenue and gross profit per user. I've never done that one before. That was cool. I did a loan to or lifetime value to customer acquisition cost. This is the one where I said it was good if it was around 7 or 8. Really good if it's higher. It's basically saying what's your cost to acquire a customer and what are they worth over the life of, which is all going to be based. It's going to have based on the retention and the values you're getting up here. We got monthly churn. So this is actually the resulting monthly churn if you apply a certain retention rate and a certain growth over time. You can see it just goes up until you finally stabilize. And here it's kind of stays steady, which is expected. You've got active users by type, annual revenue by type, and these are all stack charts. So this top is the total. Each section is actually how much they contributed. So no ad service is 4 million, InApp is 31, ad revenue is 9. If you add them all together, you get this 45, and that's what it does for each year. You got same style with this one, but it's in-app purchase revenue by type. So this is breaking down the in-app purchase, this one bar right here, the blue, into its 5 different types. Then you got average monthly revenue or gross profit per user. Oop, this needs a legend in the bottom. Customer acquisition cost and month to payback customer acquisition cost, this was another important one. Based on how much it costs to acquire a customer, if you look at the gross profit that average customer gives you in a given month, how many months will it take to pay back that customer acquisition cost? So this is another important one. All right. Well, I think that's all I got. Now, if you've stayed to the end, I've got a prize for you. If you purchase this model, which is going to be a one-time fee of $75, I will give you half off any purchase at smarthelping.com. And it doesn't matter if you buy it on a different site, whatever, just email me, say, hey, I bought your mobile app freemium model with in-app purchases, and I now am going to purchase something else and I want 50% off that, and I'll say, great, PayPal me, and I'll send you whatever you want for half, and it'll be half price. It could be one of my bulk discounts, which I offer on the site at smarthelping.com. It could be like I do all mid-level models are a price, all intermediate levels are a price, all high-level models are a price. I also do it by category. Any purchase you make one time after you buy this, it's just half off. So real simple, and I figure that's a good reward if you stayed and watched the whole thing. Um, enjoy that. And again, smarthelping.com is where you can go to do that. And just email me, Jason at smarthelping.com. All right. I'll see you on the next one.